Hey everybody, Rob Maurer here, and we have a relatively quiet news day for Tesla despite all of the action with the stock, and even the stock today taking a little bit of a break. I'm recording before close, but right now we're trading pretty close to even on the day, though down from yesterday's after-hour session. But the biggest news for today seems to be updated price targets from Morgan Stanley. And I say price targets, of course, because Morgan Stanley has bull case, bear case, and base case price targets for Tesla stock. The updated note, which was issued this morning before market open, was titled, quote, "The Great Re-Rating. Tesla price target to $740, bull case to $2,070. So Morgan Stanley has increased their price target from $650 to $740, but probably more notably and seemingly catching more attention is that bull case, which has increased from $1,200 per share to $2,070 per share. We'll go through the details driving both of those price targets, but first I want to go through the commentary from the note, which opens with, quote, "Tesla was already seen as the undisputed leader in EVs and Auto 2.0, but a resilient second quarter, demand, and likely profit is now making the company appear less risky/stronger financially than other OEMs, sending the stock well above our prior bull case," end quote. I guess that makes it time for an update, and as we talked about yesterday, Wedbush has increased their price target for their bull case up to $2,000 per share, so Morgan Stanley sliding in right above that now at $2,070. But Morgan Stanley's Adam Jonas asks the question in the note of, quote, "What have we learned that is truly thesis changing over the past week?" End quote. They highlight three areas in this. They say that Q2 production and demand were ahead of expectations. Differentiation from other OEMs has been shown, saying that demand is holding up better than other OEMs, with Tesla only down about 5% year over year in Q2 versus other OEMs in that 20 to 30% range. And then Jonas notes that that top line resiliency on deliveries and revenue would also likely lead to a stronger balance sheet performance from Tesla, noting that competitors in this quarter and in the first half of the year have burned billions of dollars in free cash flow, while adding that, quote, "Tesla, on the other hand, may see some cash consumption from working capital, but is in a position to post an above break-even US GAAP result in the second quarter. In both absolute and relative terms, Tesla appears ready to impress the street for second quarter," end quote. So the relative performance is something that we've talked about going back to the start of the coronavirus situation. My thesis for a long time has been that will apply more pressure to others than it will for Tesla, and that will cause them to fall further behind. So when Jonas says, "What have we learned that is thesis changing over the past week?" Well, it's really just Tesla demonstrating what is happening with the financial results and their delivery and production report. Jonas notes that these results de-risk Tesla as a company, allowing them to appeal to a whole new set of investors. Clearly, that is the concept that has so many intrigued by the possibility of S&P 500 inclusion. While we will keep talking about that, it's also important to understand that it's not just the S&P 500 or the S&P 500 tracking funds. Investors everywhere have all sorts of different rules and all sorts of different filters for companies, and one popular filter is a company needs to be profitable for a year. Over the last 4 quarters, Q2 2019 through Q1 2020, Tesla showed a loss of $144 million on the GAAP net income line, meaning a lot of investors simply wouldn't even consider buying the company. As we look forward to Q2, even if Tesla doesn't show a profitable quarter, that likely changes. Q2 2019 was the only loss in the last 4 quarters. That was $408 million. So as we move forward 1 quarter, that drops off of the trailing 12 months, meaning that we're then adding the profits from Q3 2019, Q4 2019, Q1 2020, which total $264 million, to whatever Tesla ends up posting for Q2. So as we've talked about, we do expect a profit in Q2, but even if Tesla doesn't report a profit, as long as the loss isn't $264 million, the last 12 months are going to end up being profitable in summation for Tesla. That gets Tesla through a lot of filters. Back to the Jonas note though, as I said, Morgan Stanley is expecting cash burn from Tesla for the second quarter, and that forecast is negative $1 billion in free cash flow. I don't understand that forecast at all because Tesla delivered about 8,400 more vehicles than they produced this quarter. That probably ends up being $500 million in free cash flow tailwind in Q2, as the cash cost for those vehicles was already accounted for in Q1, but the cash then comes in Q2 because Tesla sold those vehicles. Q2 last year was actually very similar. Tesla delivered about 8,300 more vehicles than they produced in Q2 of 2019. Free cash flow for that quarter was positive $614 million. I'll be very surprised if Tesla's free cash flow for Q2 isn't positive, and I would be absolutely shocked if it's negative to the tune of $1 billion. We'll go through forecasts on these important lines though as we get closer to Q2 earnings. Rounding out the commentary from the note then, Jonas says that their long-term concerns on Tesla stock remain, essentially that the market is fully pricing in the upside but not accounting for the risks facing Tesla. They say, quote, "Our concerns around sustainability of profit in China, poor auto industry fundamentals, and what we believe to be inevitable competition in EVs and AVs from a host of well-capitalized tech firms, Amazon, Apple, Google, etc., are just not seen by the market as a big enough part of the narrative for the remainder of 2020, end quote. This theme of competition coming in from tech companies has been discussed by Morgan Stanley as a risk for a few months now at least, so nothing new there, but I did want to add my thoughts on the topic. These companies are worth keeping an eye on, but manufacturing stuff is hard. Elon has talked about that at length, and none of those companies are really manufacturing companies. Apple slightly, but they outsource a lot of that manufacturing obviously to Foxconn. You can't just come in with a lot of money and make a competitive product to something like a Tesla vehicle right off the bat. Tesla has been working tirelessly on this for 2 decades to get to the point where they are now. You don't just come in new and start where they start, let alone somehow start ahead of where Tesla is today. That just will not happen. I also don't view it as a good excuse for these price targets, so we'll get into the details of where these numbers are driven from. Starting with the base case, Jonas has increased their 2020 forecast up from 420,000 deliveries for the year now to 475,000, and their 2021 expectations up from 620,000 to 640,000. Never mind the fact that in Tesla's Q1 letter, as we've talked a lot about, they said that they have installed capacity for 690,000 vehicles annually, and they expect to increase that to 790,000 by the end of this year. So Jonas is forecasting Tesla to operate at 80% of capacity next year, and that doesn't even account for increased capacity from further ramping up Shanghai, adding Model Y production to that factory, and then of course Giga Berlin, and potentially even Giga Texas or long shot Tulsa next year as well. So we're probably more interested in the math behind the bull case. Jonas and Morgan Stanley have increased their vehicle delivery forecast for 2030 in the bull case, up from 4 million vehicles previously and a 12% EBITDA margin to 6 million now in 2030 on 20% EBITDA margins. Remember, on the last earnings call, Elon said he would be very shocked if the compound annual growth rate for the automotive business isn't 40% or more. That would imply about 15 million vehicles delivered in 2030. So at least we're seeing some progress from analysts starting to edge up in that direction, even if it is just in these bull cases. Bringing this back to Morgan Stanley's point on competition though, 6 million vehicles in 2030 likely represents about 10%, maybe even less than 10% of the automotive market. So even significant competition from Apple, Google, Amazon, whoever else still leaves plenty of room for this bull case from Adam Jonas. So I don't really see how that can be stated as a concern for their base case. Maybe that becomes a concern if you start forecasting 20 million or 30 million vehicles sold from Tesla in that out year of 2030. But if you're already forecasting 90+% of the market to go to competitors anyway, it seems a little bit redundant to then discount the stock because of threat of competition. You already did that. Anyway, I think that's a good spot to leave it for today. So as always, thank you for listening. Don't forget to subscribe and sign up for notifications. I really do appreciate that. Even if you do watch the videos every day, the subscriber number does help. Helps with things like getting better access to produce better content, which is a similar reason you should follow me on Twitter at Tesla Podcast as well. People look at those numbers grant influence. I appreciate it, and I'll see you tomorrow for the Wednesday, July 8th episode of Tesla Daily. Thank you.